Your HR department called it a sophisticated wealth-building tool. Your benefits coordinator walked you through the tax deferral math with the calm confidence of someone who genuinely believed what they were saying. And on paper, it looks pristine. Defer $150,000 of your $300,000 compensation package. Bypass the $23,500 401k ceiling entirely and watch your taxable income collapse while your deferred balance compounds. What they did not tell you is that the moment you signed that enrollment form, you stopped being an investor. You became an unsecured creditor. This is not a niche academic risk buried in a footnote. This is a structural wealth extraction mechanism operating at the intersection of IRC Section 409A and your company's corporate balance sheet strategy. The executives pushing non-qualified deferred compensation plans are not offering you a sophisticated perk. They are accessing a zero-interest loan, financed entirely by your future wealth. Here is the clinical reality. When you defer compensation into an NQDC plan, those funds do not move into a protected trust. They do not sit in a segregated account with your name on it. They are absorbed directly into the company's general operating assets, legally, contractually, and without apology. Your $150,000 deferred balance? It's a line item on the corporate balance sheet. It's corporate float. And if your employer files for Chapter 11, you stand behind the bondholders, the secured lenders, and the institutional debt holders. Every single one of them gets paid before you recover a dollar. The behavioral psychology behind why high performers fall into the trap is almost surgical in its precision. When you cross $250,000 in annual compensation, something shifts in how institutions treat you. The language changes. The benefits packages get more sophisticated. HR stops talking to you like an employee and starts talking to you like a partner. You're invited to executive briefings on wealth optimization. You receive bespoke compensation architecture designed specifically for your income bracket. This is not generosity. This is leverage. The moment you feel treated like an insider, your skepticism drops. Behavioral economists call this the elite trust bias. The measurable tendency of high-earning professionals to under-scrutinize financial instruments that are presented within a premium institutional context. You didn't question your Goldman credit facility terms the way you would have questioned a car dealership. The environment signals safety, so your due diligence instinct disengages. And that is precisely when Section 409A walks through the door. Let's name this mechanism directly. Call it what it actually is: corporate phantom equity extraction. Here's how it operates in practice. Your company's treasury team carries deferred compensation obligations as long-term liabilities on the balance sheet. But because these liabilities are owed to employees, not institutional creditors, they carry zero interest burden and face zero margin calls. The company effectively uses your withheld salary as cost-free working capital. Funds internal operations, services existing corporate debt, or in more aggressive cases, supports leveraged buyout structures that the very executives enrolling you in these plans personally benefit from. You deferred the tax. The company deferred the risk entirely onto you. The IRS designed Section 409A after the Enron collapse in 2001, when thousands of executives watched their deferred compensation evaporate because it was classified as an unsecured corporate obligation. Congress responded with rigid distribution and acceleration rules, theoretically protecting plan participants. What Section 409A did not do, and was never designed to do, is subordinate your deferred balance beneath a bankruptcy estate. The protection it offers is procedural, not structural. The financial profile of the average NQDC participant makes this risk exponentially more concentrated. A 38-year-old vice president deferring $100,000 annually over a 10-year enrollment window accumulates a deferred balance that can represent 40% to 60% of their total investable net worth, all sitting inside a single counterparty, one employer, one balance sheet, zero ERISA protection, zero FDIC backing, zero collateral. Contrast that with a 401k governed under ERISA. Those assets are held in a legally separate trust. If your employer collapses tomorrow, your 401k balance is structurally insulated from corporate creditors because it never belonged to the corporation. It was always yours. Your NQDC balance was never yours, not legally, not in bankruptcy court. The actionable shift here is not to panic exit every deferred compensation plan in existence. NQDC plans carry genuine tax efficiency advantages for executives in peak earning years, and a blanket rejection of the instrument reflects a lack of sophistication rather than wisdom. The institutional-grade response is to deploy what restructuring attorneys call a counterparty concentration analysis before every enrollment election. Before you defer a single dollar, you must independently evaluate three factors: your employer's current credit rating and debt maturity schedule, the ratio of your projected deferred balance to your total liquid investable assets, and the specific plan document language governing your distribution hierarchy in a reorganization event. If your employer carries a non-investment grade credit rating, or if your projected deferred balance will exceed 25% of your total net worth within the next 5 years, the tax deferral advantage does not justify the counterparty risk. Full stop. Redirect that capital into a properly structured taxable brokerage account with a diversified asset base and absorb the W-2 tax hit. A 37% federal rate on $150,000 costs you roughly $55,500 in taxes. Losing the entire $150,000 in a restructuring event costs you $150,000. The math is not subtle. For executives whose employer profile supports reasonable counterparty confidence, the strategy becomes about hard concentration limits, treating your NQDC balance with the same risk discipline you would apply to a single stock position. The same professionals who would never allow one equity to represent 40% of their portfolio are casually allowing one employer's solvency to represent 40% of their deferred wealth. That asymmetry is not an oversight. It's a cognitive blind spot engineered by institutional framing. The deferred compensation trap does not operate in isolation. It is one mechanism inside a broader architecture of corporate instruments that are presented as employee wealth tools, but function as corporate balance sheet management devices. The deferred compensation promise extracts your current cash flow, but there is a parallel instrument targeting your equity upside. One that works through vesting schedules, market timing illusions, and a specific tax event that most executives never model correctly, until it's far too late. The psychological machinery that made you trust the NQDC enrollment process is the same machinery that made you believe your restricted stock units represented real, liquid, accessible wealth the moment they vested. Click the video on your screen right now, and let's pull back the next layer to dissect how the RSU liquidity trap turns your stock compensation into a mathematical mirage.